So we'd have no way of verifying it, and we have to take the third-party accountant from their country of origin, but we require it just like we would on a regular 5,000 NP borrower in the United States.
How do you verify
Well, it'll come up when we run the ITIN. We use the ITIN to run the credit. Yeah, when we run the credit, we use the ITIN number to run the credit. So is everyone clear on Program 5000 FN?
Yeah. Just on your foreign international, you have the translation requirement for foreign creditors, etc. Go to an agency you guys have that.
The International Credit Reporting Company. Actually, that's what they're called. Yeah, it's got to be in English. Yeah, it's got to be in English, and if they don't put it in U.S. dollars, then we'll put a currency conversion on the letter. It's not a big deal. But generally, their income, we generally like to have if the accountant in the country of origin can actually put that in U.S. dollars. Now, some accountants in those countries are also nerds, like the U.S., and they won't because they think of it as liability. It's not the end of the world. We'll put our own. I mean, it takes 2 minutes. We just go online and do currency conversion. You just pick the country of origin and convert to U.S. dollars, and we put that in the file. We do that for assets. We do that for income. We put a currency conversion. So, for example, in the U.K., we just put British pounds to U.S. dollars, and you can actually just plug in the number. Of course, there are some variances there because depending on the day, that changes, right? We can't be perfect at it. We do our best based on the circumstances. So with that being said, unless you have more questions regarding Program 5000 FN. Yes, Mike.
Any exception in terms of ornaments with the country they don't have and they can provide ornaments?
Well, we do the International Credit Report, which is the summary, and then they get 3 trade lines. A letter from a utility company, from their bank, from something else. Well, the International Credit Reporting Company has a unique way of gathering data. The International Credit Report Company does more than just your typical downloading info online. So they will make phone calls, they contact the country, they have access, depending on the country, they will gather the info. All right, folks, let's move forward, please. So let's now jump to, I'm going to effectively reach out for program from this. I'm going to go straight to Program 5000 INV, and I've touched up on the subset on 5000 INV FN, but I'm going to go back to 5000 INV. And let's take a look at that program because it's as close, on the 5000 INV, you're as close to a no-document loan as possible. So, very simple, very straightforward program. The 5000 INV is as close to no-doc loan as possible. You have basically no income, you have no employment, you have no reserve requirements, all 3. In a case of a purchase transaction, you just need to show assets to close. Whether you're under Program 5000 INV or 5000 INV FN, you're demonstrating you have enough money to close the transaction only. We want to have employment. I was about to mention that. That's a good point. We do want their employment info on the application for servicing contact. It's only for that purpose. We're not verifying. No. It's simply having an alternative phone number, an alternative place to call them for servicing purposes only. We're not calling, we're not verifying, we're not getting a CPA letter, we're not getting a VOE, we're not getting any of that. It's simply to say, hey, besides my home, you can reach me here. Put their company, put their phone number. That's it. It's that simple. Folks, let's keep it as one conversation, please. So it's important to understand that on this program, here are the limitations. You're talking about on a purchase transaction, 75%, it's right on the matrix, 75% with 700 plus FICO score on a purchase, 70% with 640 FICO score, and 70% for a foreign national borrower. Now, across the board with LTVs I just mentioned, if the borrower is a first-time investor, whether they're foreign national or a U.S. borrower, there's a 5% reduction in LTV for first-time investor. Bless you. So who's a first-time investor? The borrower that has not invested in real estate in the last 12 months. So, I could be a borrower that buys a property and not considered a first-time investor because I had a property in the last 12 months that I had for 2 years, but I sold it. So today and now, I own only my primary residence. I don't own any investment properties, but I'm not a first-time investor because I sold another property 2 months ago as an investment property, so I'm an experienced investor. Now, if that was 2 years ago, I'm a first-time investor. If it's within the last 12 months, I'm not a first-time investor. That's extremely important to understand. Now, one other element to understand, and that, by the way, is applicable to U.S. borrowers, but we have flexibility on foreign national borrowers because we've made some cases where they own other properties in countries, for example, like UK, the example I gave. In many cases, these borrowers are a little bit more diverse. So we've looked at some other circumstances where the borrower owns, for example, commercial property, not even residential property. We've looked at that as an exception under the foreign national program. Now, one other requirement also for this program, and it's partially compliance related. 80% is compliance related. To be under program 5000 INV, the borrower has to own their primary residence. Okay? You cannot be a renter. All right? Now, one of the main reasons for that, the primary reason is we don't want this program to be used for people trying to buy a home who doesn't fit into any other programs.
So they have to own a property?
They have to own a property. They don't have to have a mortgage. The idea is we're trying to protect this program from being used for an owner-occupied deal. Okay? Now, that's not so applicable to a foreign national borrower. Under the 5000 INV-FN, there's flexibility, and in many countries, there are no benefits to owning your own home. So we deal with borrowers in other countries that don't own their primary residence. We're flexible with that because they can't be owner-occupied in the U.S. when they live in another country. That doesn't make sense, right? So that's an area of flexibility. Now, there are exceptions to the rule even for U.S. borrowers. Those exceptions are a lot easier when you're doing a refinance. Why? Because you can clearly identify who lives in the property. If you get documentation on the rental income, you can show that our borrower's been getting rental income for the property. You can get utility bills for the borrower where they claim they're renting. So we've dealt with borrowers that own investment properties, but they're renting their primary residence. Well, cancel checks on the rental, right, where they live. That helps. Deposits from the rental income. We're basically, in a refi scenario, we have an easier way of verifying that the subject property is truly an investment property, and we've made exceptions on that. So these are some common sense concepts with regards to getting an exception to the rule of the borrower owning their primary residence on the 5000 INV program. It's extremely important to understand the scenarios where that's possible. So you have a couple of LTV reductions you need to look at here. First-time investors, 5% reduction. Look down further. You've got cash out in excess of $200,000, 60 max LTV. 2 to 4 units, 70% max LTV. Unleased properties, max LTV is 65%. Only applies to refinances. So on a purchase transaction, there's no reduction in LTV if the property is not leased. But if we're doing a refinance, we expect the property to be leased out because we can't expect that on a purchase, right? You're buying the property. How are you going to make sure you got a tenant? You may be buying a property, you're going to fix it up and then lease it. That's okay. There's no LTV hit on a purchase. But there is an LTV hit if you're doing a refinance and there's nobody in your property. It raises the question, why? Very important to understand that. Now, you will see that right there. Now, a couple of things I want you to be aware of that are critical. We do also allow non-warrantable condos, but those are a max at 65 LTV as well. A couple of important things to be aware of with regards to this program, I think it's an outstanding program for you to be aware of. Again, the foreign national piece, same concept from a credit standpoint applies. All of the issues regarding the visa that I mentioned applies. All of the same, except, as I said, on the assets, you just need to show enough to close. No reserves. Sourced, currency conversion, they can use the foreign exchange program that I mentioned for UK borrowers, not allowed for any, all of those characteristics, same concepts apply. US bank account has to be set up. For UK borrowers, they can use a foreign exchange direct to the closing agent. For non-UK borrowers, the funds have to go into a US bank account, no seasoning required. Same concepts there, okay? No DTI. So those issues that I mentioned on 5,000 FN for foreign national borrower, this is not an issue. Because remember, it's a no income loan. We don't have DTI. Effectively, your 1003 has no DTI calculations at all. Doesn't really matter. We don't care how much liabilities they have in their country of origin. But again, the rate's higher, right? You got ultimate flexibility, but you pay for it in the rate. That's, again, the philosophy across the board in the product offering. You want a better rate? Provide more documentation, stricter guidelines, tougher credit requirements, more reserves. You're going to get better pricing. You want to provide less? You're going to have a higher rate. So we're dealing with the whole spectrum of different caliber of borrowers that have different expectations, and at the same time, they're willing to provide more information and more documentation to get the better rate. It goes hand in hand. So those are some important elements to consider under this program. Are there any questions to be aware of? And please take a look at your guidelines.
I heard a couple where the borrowers live on the East Coast and vice versa, and they have been transferred, so they're renting out their property, so they're now renting a property in California, and they've rented out their Connecticut property long term.
With documentation, again, we're here to make loans work. We're here to make deals work. So as long as we can make sense of it and we can truly document it, we will consider that, okay? Something else to be aware of on this program, extremely important under this program, is that we look very closely, because it's got very limited documentation, 5,000 INV and 5,000 INV DTI that I'm going to talk about in a minute, we look very closely at the property condition type. What do I mean by that? You've got on the appraisal that comes in, by the way, it's mandatory. Rental survey is required on every investor loan, regardless of whether it's bank statement or INV, DTI or regular INV. But we look at what the appraiser classifies the property. Well, there are 6 grades they can give the property condition. C1 being the best, C6 being the worst. C1 is basically new construction. Basically, the property is perfect, right? It's brand new. We only allow lending on our INV programs C1 to C3. C4, C5, C6 are typically ineligible for these programs, okay? And the reason being, C4 indicates there's deferred maintenance. The property is not properly maintained, okay? So what happens is the appraisal department now, when on every appraisal that comes in the door, they've been instructed to watch the condition grade on the property, and they send an email to operations regarding the condition type so that they give them sort of a heads up. Hey, you've got an issue here. You've got a property with C4 rating or C5. C5, forget it. There's no way to do a C5. On individual cases, we've made exceptions on even C4 loans. I'll give you an example. We did, the best example I can think of is my friend John back there has done a couple of loans. Yes, he's done a couple of loans that were $1 million each, where both of the properties in LA were C4. But they were taking cash out for improvement to the property. So they were slightly lower LTV loans than our guidelines allow. So we had a little bit of buffer there. And we documented how the borrower was going to take the cash out to actually do improvements to the property. So we got contractors bid letter from the borrower. I looked at it. I signed off on exception on 2 of these loans, showing that the borrower was going to use the money partially to fix up the properties. That made sense. In a case of a purchase transaction, we could consider the same, but at a reduced LTV. So we've had cases on a purchase transaction where the borrower is buying a property, comes in with C4, and the borrower has also contractor's bid and has enough assets verified to actually do the work. That's where you need extra assets, right? Because if our program requires no reserves and you have no money to fix up the property, you cannot tell me that you're going to convert this property from C4 to C3. Where's the money coming from, right, on a purchase transaction? On the cash out, it's a little bit easier, and it was slightly lower LTV. So the borrower was like at 60 LTV. So it made sense. At 60 LTV, both loans were $1 million in LA. There was cash out, enough cash out for the borrower to use to match up to the contractor's bid. It was a make sense transaction, right? Those are areas for exceptions to the rule.
No fund held in escrow on that?
No, we don't do any escrow holdbacks. We don't do that at all on anything. And the truth of the matter is, we have no way of verifying if the borrower ever actually did that, frankly. We're accepting a letter from the borrower, contractor's bid, and we're documenting in the file that there are enough assets available. In the case of a cash out, we know that for a fact. In the case of a purchase, we look for those added assets in our file to show, hey, $40,000, $50,000 is needed to fix up this property. Here's a contractor's bid. This will likely move the property from a C4 to a C3, and then that makes it okay. But these are some critical elements you need to be aware of under the INV programs.
C3 is
Cutoff. C4 is an exception based on extenuating circumstances that I just gave you.
not all of our programs.
No, that's on these programs, on the INV programs, correct. I'm sorry? I believe we're C4 capped on the other ones. No, I don't think we go to C5. C5 is a substandard property.
C4 is about as low as we're going.
Absolutely, yes. Yes, C4 is the absolute lowest. On these programs, it's an exception. On the other ones, we go down to C4 under normal circumstances. Any questions regarding these programs so far?